Every central banker proclaims markets remain adequately supervised. Every financial regulator swears systemic risks undergo continuous monitoring. And every single time, they're deliberately concealing the most catastrophic financial mechanism ever constructed. The shadow banking system, a $100 trillion apparatus operating perpetually beyond governmental regulatory frameworks, an invisible financial infrastructure that processes more capital daily than conventional banking institutions combined, yet exists almost completely unmonitored. Most people believe banking remains confined to familiar institutions. Chase, Bank of America, Wells Fargo, your neighborhood credit union, regulated entities subject to governmental oversight, capital requirements, stress testing protocols. This comprehension proves dangerously incomplete. Approximately 50 to 60% of global financial intermediation now occurs outside traditional banking frameworks. Hedge funds, private equity firms, money market funds, structured investment vehicles, shadow lenders operating in jurisdictional gray zones, cryptocurrency platforms. These entities collectively process approximately $100 trillion in annual financial flows, yet face virtually zero regulatory intervention. But here's what should genuinely terrify you. When 2008's financial crisis devastated global economies, investigations revealed that shadow banking institutions bore substantial responsibility. Yet nobody implemented meaningful regulatory reforms. Shadow banking simply adapted, evolved, grew larger. Now, $100 trillion later, the apparatus is infinitely more interconnected, exponentially more leveraged, and substantially more fragile than 2008's predecessor system. The question isn't whether another financial catastrophe will emerge. The question is whether governmental institutions possess any capacity whatsoever for preventing it. Because when an unregulated $100 trillion financial system collapses, conventional monetary policy becomes irrelevant, central bank interventions prove insufficient, governmental bailout mechanisms become mathematically impossible. What follows isn't recession, it's systemic civilizational breakdown. Traditional banking represents merely the tip of contemporary financial architecture. Beneath legitimate banking institutions exists an entirely parallel financial ecosystem. Operating according to fundamentally different principles, shadow banking comprises financial intermediaries functioning outside conventional regulatory frameworks. These entities perform essentially identical functions to traditional banks accepting capital, channeling funds toward investment opportunities, managing liquidity flows yet operate without regulatory supervision, capital requirement constraints, or governmental oversight mechanisms. The phenomenon commenced innocuously during the 1980s when financial innovation began circumventing regulatory restrictions. Investment banks discovered that securitization mechanisms permitted mortgage origination without balance sheet constraints. They could originate mortgages, immediately transform them into tradable securities, and transfer risk toward unsuspecting investors. This innovation appeared elegant. It theoretically distributed risk throughout financial systems rather than concentrating it within individual institutions. Policymakers celebrated this development as progressive financial engineering. They fundamentally misunderstood the consequences. By transforming mortgages into tradable commodities, originators eliminated incentive structures for ensuring borrower creditworthiness. Previous banking models required originators maintaining mortgage portfolios, thus incentivizing rigorous borrower evaluation. Securitization eliminated this discipline. Originators received compensation regardless of eventual borrower default probabilities. Throughout the 1990s to 2000s, shadow banking expanded exponentially. Private equity firms accumulated unprecedented capital pools, Hedge funds proliferated across global financial centers. Money market funds grew to unprecedented magnitudes. Structured investment vehicles multiplied, cryptocurrency platforms emerged, claiming to operate without intermediaries. By 2007, shadow banking had expanded to approximately $60 trillion in aggregate assets. Then 2008 arrived. Shadow banking mechanisms collapsed catastrophically, and governments implemented emergency interventions preventing complete systemic disintegration. Yet, rather than implementing fundamental regulatory reforms, policymakers permitted shadow banking to reconstitute itself. By 2024, shadow banking had expanded beyond $100 trillion, representing growth substantially exceeding pre-crisis magnitudes. Now, here's where this becomes controversial. Certain economists argue that shadow banking provides beneficial market flexibility and financial innovation that conventional banking couldn't accommodate. Others insist that unregulated shadow banking represents civilizational suicide disguised as financial sophistication. I lean toward the latter interpretation because the scale exceeds governmental intervention capacity. But I want to hear from you. Drop a comment. Should shadow banking face stringent governmental regulation, or does regulatory intervention stifle beneficial financial innovation? The evidence could support either perspective. Let's debate what you genuinely believe. The terminology itself, shadow banking, deliberately obscures reality. These aren't peripheral financial operations. They represent primary financial intermediation channels, pension funds, root contributions through shadow banking entities, insurance companies position capital through shadow mechanisms, sovereign wealth funds deploy resources via shadow institutions. Approximately $4 trillion in daily financial transactions occur through shadow banking channels. Yet, these transactions involve zero regulatory oversight. Nobody monitors leverage ratios. Nobody measures systemic risk concentration. Nobody calculates whether sudden liquidity demands would trigger cascade failures. The system grew because it appeared profitable. Financial institutions discovered that shadow banking mechanisms generated superior returns compared to conventional banking. Investors flooded capital toward shadow entities seeking yield premiums. Regulators permitted this migration because they fundamentally misunderstood the systemic consequences. Understanding why shadow banking escapes regulatory intervention requires comprehending how financial regulation actually functions. Conventional banking regulation rests upon several foundational mechanisms. Capital requirements mandate that banks maintain minimum equity ratios relative to asset holdings. Reserve requirements compel banks maintaining specific currency percentages. Stress testing requires banks demonstrating capacity for surviving adverse economic circumstances. Regulatory examinations enable governmental authorities assessing institution safety. These mechanisms appeared sensible following repeated historical financial catastrophes. Yet they apply exclusively toward entities officially classified as banks. Shadow banking institutions deliberately structure operations to avoid bank classification. A hedge fund isn't technically a bank, it's an investment manager. A private equity firm isn't a bank, it's an asset manager. A structured investment vehicle isn't a bank, it's a securitization apparatus. By reorganizing institutional structures while maintaining essentially identical financial functions, shadow entities circumvent regulatory frameworks entirely. Governments attempted addressing this regulatory arbitrage through alternative mechanisms. The Dodd-Frank legislation implemented post-2008 reforms supposedly addressing shadow banking vulnerabilities. Yet the legislation contained catastrophic design flaws. If you've witnessed regulatory frameworks that create unintended consequences, drop a comment. Your experience matters because Dodd-Frank perfectly demonstrates how regulatory intentions diverge catastrophically from actual outcomes. Dodd-Frank theoretically implemented systemic risk oversight through establishing the Financial Stability Oversight Council, a governmental body purportedly monitoring interconnected financial institutions, yet the legislation simultaneously permitted shadow banking to expand unconstrained. Private equity firms accumulated $5 trillion in managed capital completely outside regulatory frameworks. Hedge funds grew to $4 trillion in aggregate assets with minimal governmental monitoring. Cryptocurrency platforms emerged claiming to operate without governmental involvement whatsoever. The regulatory approach became fundamentally incoherent. Regulate conventional banks exhaustively while permitting shadow banking to expand exponentially. This created perverse incentive structures encouraging capital migration toward unregulated shadow mechanisms. By 2024, conventional banks represented less than 50% of global financial intermediation. Shadow institutions comprised the majority yet faced virtually zero regulatory intervention. Certain shadow institutions deliberately position themselves within regulatory gray zones. They operate across multiple jurisdictions simultaneously, exploiting differing regulatory standards. They structure transactions through subsidiary networks, obscuring actual ownership and control. They utilize offshore financial centers specifically because those jurisdictions prioritize financial secrecy over regulatory transparency. When regulators attempt enforcement actions, shadow institutions simply relocate. A hedge fund facing scrutiny moves to the Cayman Islands. A structured investment vehicle migrates to Luxembourg. A cryptocurrency platform transfers operations to Singapore. This regulatory arbitrage game became utterly predictable. Shadow banking entities discovered that regulators possessed neither resources nor jurisdictional authority for enforcing compliance across global financial systems. The $100 trillion shadow banking apparatus comprises numerous distinct institutional categories, each introducing specific systemic vulnerabilities. Private equity firms represent shadow banking's most aggressive capital concentrators. These organizations accumulate enormous capital pools, sometimes exceeding $100 billion per fund, then deploy this capital acquiring companies, restructuring operations, and subsequently divesting assets seeking profit maximization. This business model functions entirely through leverage. Private equity firms typically finance acquisitions through combination of investor capital, approximately 30%, and debt instruments, approximately 70%. This leverage amplifies returns during economic expansions. A company generating 10% annual returns produces 33% investor returns when financed through 70% leverage. Yet this leverage creates catastrophic fragility. When economic circumstances deteriorate and acquired companies underperform, leverage transforms manageable losses into institution-threatening catastrophes. Private equity firms possess minimal incentive for conservative risk management because they receive management fee compensation. Regardless of eventual investor outcomes, hedge funds represent alternative shadow banking category. These institutions manage approximately $4 trillion in capital through strategies ranging from conventional equity investing to exotic derivative speculation. Hedge funds operate with minimal regulatory oversight, minimal disclosure requirements, and minimal transparency regarding actual leverage and risk exposure. Money market funds constitute third shadow banking category. These institutions theoretically invest exclusively in short-term debt instruments, supposedly generating minimal risk exposure, yet during financial stress periods, money market funds have repeatedly demonstrated severe fragility. During 2008's crisis, money market funds confronted massive redemption demands, triggering forced asset sales and creating downward price spirals. Here's my prediction. The next financial crisis will originate within money market fund mechanisms. When simultaneous redemption demands exceed available liquidity, I could be wrong. Financial crises occasionally surprise observers. Yet money market fund structural vulnerabilities appear increasingly concentrated. Structured investment vehicles represent increasingly concerning shadow banking category. These entities acquire mortgage securities, collateralize debt obligations, and alternative investment instruments, then finance these acquisitions through short-term debt obligations. When short-term refinancing becomes impossible, as occurred during 2008, these vehicles confront immediate insolvency. Cryptocurrency platforms constitute newest shadow banking category. These institutions theoretically operate without intermediaries, yet actually function as centralized financial intermediaries managing customer capital. Cryptocurrency exchanges process trillions in daily transaction volume while maintaining minimal regulatory oversight and minimal customer capital protections. When cryptocurrency platforms experience operational failures, as occurred repeatedly during 2022 to 2023, customer capital simply evaporates without governmental recourse. These shadow institutions remain deeply interconnected through complex derivatives, credit default swaps, and counterparty relationships. When individual shadow entities experience difficulties, the interconnectedness transmits stress throughout entire financial systems. Financial systems possess threshold dynamics. Small perturbations produce minimal consequences until critical trigger points emerge. At that moment, minor shocks cascade into civilization-threatening catastrophes. Contemporary shadow banking operates at precisely such threshold conditions. Leverage ratios exceed sustainable magnitudes. Interconnectedness creates vulnerability concentration. Liquidity mismatches generate fragility. Consider potential trigger mechanisms. A significant commercial real estate default could precipitate private equity fund losses. Simultaneously, pension funds holding private equity stakes would confront investment losses. Insurance companies maintaining exposure would experience underperformance. Money market funds holding corporate debt would face credit deterioration. Each entity attempts simultaneously liquidating positions. Asset prices collapse from sell pressure. Leverage ratios deteriorate. Margin calls force additional liquidations. Asset prices decline further. The cascade accelerates. Central banks attempt interventions reducing interest rates, injecting liquidity, purchasing assets. Yet when shadow banking systems collapse simultaneously, central bank intervention capacity proves insufficient. The $100 trillion system operates at magnitudes exceeding governmental intervention mechanisms. Historical precedents demonstrate this dynamic. During 2008, even aggressive governmental intervention emergency interest rate reductions, massive quantitative easing, direct financial institution capital injections merely prevented complete systemic disintegration. Complete recovery required years. Yet 2008's shadow banking system represented merely $60 trillion. Contemporary shadow banking encompasses $100 trillion. Governmental intervention capacity hasn't expanded proportionally. When financial systems collapse, the consequences extend far beyond Wall Street disruption. Global supply chains depend upon trade finance mechanisms. International commerce requires credit availability. Business investment depends upon capital accessibility. Financial system collapse triggers immediate real economy consequences. Businesses cannot secure working capital. Consumer lending becomes unavailable. Real estate transactions halt. Economic activity contracts sharply. Previous financial crises produced severe recessions. Substantial unemployment increases, significant income declines, substantial asset value deterioration, yet governmental institutions possessed capacity for implementing emergency interventions. Central bank balance sheet expansion, governmental spending increases, direct financial system recapitalization. Future financial crises originating within shadow banking systems might exceed governmental intervention capacity. When $100 trillion in financial assets confront simultaneous stress, traditional policy tools become mathematically insufficient. The chain reaction unfolds predictably. Shadow banking stress triggers conventional bank vulnerability exposure. Conventional bank difficulties create credit market seizures. Credit market disruptions cascade into real economy contraction. Real economy collapse produces governmental revenue collapses. Governmental revenue losses prevent intervention spending. Intervention spending becomes mathematically impossible. At that point, financial system dysfunction becomes systemic civilizational disruption. Yet, remarkably, governmental authorities continue permitting shadow banking expansion without implementing meaningful regulatory constraints. Policymakers appear to have learned absolutely nothing from 2008's catastrophic consequences. This represents perhaps the greatest policy failure imaginable. Governments consciously permitting financial system risks to multiply exponentially whilst maintaining capacity for preventing such accumulation. I've examined shadow banking's historical emergence, its regulatory escape mechanisms, its systemic risk concentration, and its collapse dynamics. But I might have overlooked crucial considerations. What shadow banking vulnerability concerns you most? What regulatory mechanisms would address systemic risks effectively? What policy failures deserve immediate correction? Financial analysts, regulatory experts, risk management specialists, concerned citizens. All perspectives welcome in the comments. Let's collectively develop comprehensive understanding regarding $100 trillion in systemic fragility, because here's what shadow banking ultimately represents. A collective wager that catastrophic outcomes will never materialize. Investors assume stability persists indefinitely. Regulators assume existing frameworks suffice. Institutions assume liquidity permanence. Yet financial history demonstrates repeatedly that catastrophic outcomes inevitably arrive. The shadow banking system will collapse eventually. The only uncertainty involves timing and magnitude. When it does, governmental institutions will desperately attempt intervention. Yet, when $100 trillion in unregulated financial assets confront simultaneous stress, intervention capacity becomes irrelevant. If this financial analysis fundamentally altered your understanding regarding hidden systemic risks threatening civilizational stability, hit subscribe. Because comprehending these mechanisms proves increasingly essential for navigating forthcoming financial disruption. Check the description for shadow banking institutional research, financial stability analysis documentation, and detailed examination of regulatory frameworks that failed preventing systemic concentration